When I first started leading business scaling initiatives, I thought fundraising was the hard part. Hi, everyone. My name is Sam Palazzolo. Let's talk about capital allocation for business growth strategies. I'm ex-Deloitte, and my business today is helping leaders grow themselves and their businesses with real strategies and real solutions. I had this mentality that went something like, if we could just land the money, we'd win. And for a while, that's what we chased. Funding rounds, investors, capital partners. I figured that once the cash showed up, success would just follow. But the reality, it hit harder and faster than I ever expected. These are my two truths. Truth one, capital doesn't guarantee growth. And truth two, capital magnifies your decisions, for better or worse. And that's just not me talking and my experience. According to McKinsey, 40% of corporate underperformance, it comes from poor capital allocation decisions. And meanwhile, my friends at Bain, they say that companies who handle capital well, they generate 30 to 50% higher returns. That's a massive gap. And today, I want to walk you through exactly why that gap exists and how you can make sure you're on the right side of it. You see, capital isn't a strategy. Capital is a magnifier. If your leadership, your strategy, your execution is sound, capital scales it. However, if your leadership, your strategy, your execution is broken, capital just breaks it faster. That's the brutal truth. No one teaches you during the fundraising phase. It's why two companies can raise the same amount of money, one scales profitably, the other crashes out in just 2 years or less. The difference is how they allocate. So let's take a look at what I think are 4 key points to capital allocation. Key point 1, tie every investment directly to strategy. Let's start with the foundation. Every dollar you allocate, it has to be tied directly to a strategic outcome. At one point, I worked with a company that had budgeted $2 million for brand marketing campaigns. When we dug in, there was no measurable KPI or metric attached. It was about increasing awareness, they said. But there wasn't a clear link to customer acquisition, retention, or revenue growth. They weren't investing, they were donating. Here's what I see. Real strategy, real result. The best operators, they tie capital to outcomes. For example, this $50,000 will acquire 1,000 new qualified leads. Here's another example. This $150,000, it'll cut operational churn by 10%. Third example, this $500,000, 500,000, will fund a new product line that hits the market by Q3. If you can't connect the spend to a strategic lever, you shouldn't allocate the dollars. It's that simple. So here's my practical advice. Before approving anything over $10,000, ask yourself, how does this directly advance our strategic plan? That's key point number 1. Tie everything, every investment directly to strategy. Key point number 2, build cross-functional capital allocation governance. What are we talking about here? One of the biggest dangers in capital allocation is siloed decision-making, where each department fights for its budget, regardless of whether it's best for the overall business. You know, I worked with a leadership team where sales, marketing, and product development each built separate budget plans. And then they fought in the boardroom to get approval. No surprise, they burned millions of dollars before anyone realized, the spending isn't exactly coordinated toward any common goal. How do we fix it? Well, we put together a cross-functional capital allocation committee, which forced collaboration. It brought together finance, operation, marketing, product strategy, all of those different silos, whoever touched the major initiatives, and evaluated every funding decision collectively. My real strategy, real result here, this type of governance doesn't slow things down. It filters decisions faster because bad ideas can't hide inside departmental wish lists. You got to align capital with strategy in real time, and that keeps growth momentum alive. This is key point number 2, building cross-functional capital allocation governance. Key point number 3, defend against behavioral bias. Even great leaders have bad instincts sometimes. Why? Because humans are wired for biases. Here's 3 of my favorite. Loss aversion. Sam, we can't cut that. We've already spent so much. Sound familiar? Or how about overconfidence? Sam, we're different. This market will come around. Yeah. Or maybe it's anchoring. Well, Sam, we planned for $1 million. We should still spend it, right? Real strategy, real result here. A client I once advised insisted on funding a second office expansion, even when early data showed weak local demand. They were emotionally anchored to the original plan, and maybe their ego got in the way. It took a hard set of boardroom conversations and finally some data from quarterly reviews to get them to pivot. Real solution here? You must build decision frameworks that kill biases. Set clear milestones-based funding that gates. And use objective metrics to continue or pull funding. Here's my best advice. Create 2 questions you ask about every major allocation. Are we assuming success or proving it? Second question, what objective data tells us this is still the best move? If you can't answer both, pause the funding. That's key point number 3. Defend against behavioral bias. Key point number 4, review and allocate capital quarterly. Markets shift fast. Sticking with outdated capital plans just because that's what we approved is a recipe for disaster and irrelevance. Here's a real-world story. One scaling tech company that I worked with, they had a full $500,000 budgeted for in-person events right before a massive digital shift hit the industry. They were ready to proceed until we pulled quarterly data and realized that customer behavior, it had already shifted and moved online. So what did we do? Well, we reallocated half the budget into digital lead gen, and we doubled pipeline growth that quarter as a result. What's the lesson here? Quarterly reallocation isn't about second guessing. It's about adapting intelligently. At every quarterly review, you should ask the 3 following questions. Question 1, what's winning right now? Question number 2, Where do we double down? And question number 3, what do we cut or delay? Capital should flow to momentum, not memory. This is key point number 4. Review and reallocate capital quarterly. So those are our 4 key points. If you take nothing else from our conversation here today, take this. Capital isn't a victory lap. It's a magnifying glass. If your strategic thinking is clear, your capital will accelerate results. If your strategy thinking is sloppy, though, your capital, it'll amplify mistakes. Every dollar you allocate is a leadership decision. It tells your team and the market what you actually believe will create growth. If all of this capital allocation conversation resonates with you and you're serious about scaling smarter, not just scaling bigger, there are 3 places that we can go deeper. First, executive coaching. Each year, I work with a handful of leaders looking to scale themselves and their organizations. Second, sales and marketing acceleration program. My ex-partner and I, we developed an accelerator that's powered by AI and fueled with my Deloitte strategy. We're compressing sales cycles and we're building real growth momentum in just 90 days. And third, my Catalyst programs, where I help leaders like you lead yourself, lead your teams, and scale your business organically or inorganically with real strategies and real results. Details are in this post or up in my bio. Thanks again for joining me, Sam Palazzolo, Real Strategies, Real Results.